Hi, everyone. It's Christine Kopr here with your November market update. October numbers are in, and we're going to take a look and see how the Vancouver real estate market is doing. Not only do we have the numbers, however, there's been a lot of political movement with major announcements that will be impacting real estate in the future. Make sure you check out some of the other videos. If you're on my newsletter list, it's all going to be in my newsletter. Otherwise, you have to check out my YouTube channel about new announcements about development in the entire province, which is going to impact virtually all homeowners. So a lot of announcements there, but let's take a look at the stats and see how things are doing. Every month, I like to go through the general outlook of what's happening in the real estate market for the Real Estate Board of Greater Vancouver. This is a high-level look of what's happening in the marketplace, and the area spans from Maple Ridge all the way to Whistler. So please remember, we're not honing in onto any one market type. Detached prices from a benchmark perspective between the west side of Vancouver and the east side of Vancouver range wildly from like 3.5 million for a house to 1.8-ish for a house on the east side. So remember, we're looking at this as a global perspective, a high level overview as what's happening in the market. If you're thinking about listing a property or selling a property or even buying a property, we go into much more detail for you. So please reach out to me in that regard. For October, the numbers are in, and I like to go through this table. So sales, we're going to start with sales. How many buyers are in the marketplace? What kind of activity are we seeing? So we knocked off 1,996 sales. That was up slightly, 3.6% month over month, which is really positive news because in September, it was starting to look like sales were going to slow down here. And of course, the result of these couple of interest rate increases that we saw back in June and July. For those of you who aren't familiar with my graph, you can see the percentage increases in the interest rate and then also the meetings where they were held. So we had a couple here in the summer when we thought the rate increase cycle had potentially come to an end. However, inflation and such got out of the way, and the Bank of Canada had to increase the overnight rate again, impacting anyone with a variable mortgage or a line of credit, something that floats. Didn't impact your fixed rate mortgages that were not maturing anytime soon, that is. So we saw a bit of a slowdown here in September. However, October knocked out that 1,996 sales and last month, and that was actually up 3.7% year over year. To put that into context, last fall, it felt like the sky was falling. And that's exactly when we gave away over double-digit gains were lost over last fall because we had subsequent interest rate increases month over month over month over month. And by the time we were getting into the fall, it really looked like there was no end in sight, and the sentiment was quite negative. I don't want to downplay the fact that the sentiment has changed in the marketplace, but I'd say so far it's not feeling like that yet. And this is a really good sign because we still kind of eked out 100 more sales this year when our interest rates are significantly higher than last fall, and we still outpaced last October's sales. They're not spectacular sales. We're down, 29, we call it 30% below the 10-year average. So it's not like we're hitting it out of the park in terms of sales, but in terms of the activity that's out there, it's chugging along, but it is on the slower side. And that's something that we need to keep in mind. Sales have slowed from our long-term average. Obviously, there's a lot of factors, interest rates being a big part of that. That's the appetite. How many buyers are out there? Well, it's slower. However, we got some sales, so that's positive. Listings, new listings, how many new properties came on the market for sale? And we clocked out at 4,664. That's actually down almost 15% month over month. Kind of makes sense because we're heading into the fall. Most owners like to wait till the spring. You aren't generally listing in the fall. However, it is the second strongest season. So it's great to see activity. However, it's starting to taper off as we get closer into November and December. The new listings were up 15% year over year. So a lot more listings than we did last year. And they are almost 5% above the 10-year average of what gets listed this time of year seasonally. So, the question is, are we starting to see a bit more activity? Are properties coming onto the market for whatever reason? Are sellers more inclined to sell? Are people maybe struggling? Although we haven't really seen too much of that yet. Active listings is the total amount of listings that are available for sale and we had 11,599 homes available at the end of October, which is an increase of about 2% month over month and a year over year increase about 13%. So a bit more inventory this year than we had last year, and it's about flat for our 10-year average. So that's great. Technically, from a long-term perspective, we have relatively low listings. The inventory is still low. For example, in the 2008 global financial crisis, you would see significantly higher numbers of listings, which means a lot more supply. And if your sales are anemic, well, then obviously you're going to have a lot more supply than there is sales, and that starts to put downward pressure on prices. In terms of inventory, we would say overall the market is in a historic low, inching up a little bit. So we are getting a little bit more opportunity, a little bit more options for buyers, and anybody who is, thinking about moving up or trading down. There's a little bit more opportunities for you there, more to choose from. And there are some sales, but they are very low compared to our 10-year average. Now, I like to really take a look at months of inventory from a very high perspective to see how we're doing for months of inventory. And because I believe it's one of the quickest ways to see which way prices are going to go. Months of inventory is how much inventory do we have available divided by the amount of sales we had in October. And assuming we don't have any more inventory come onto the market, how many months would it take at today's sales pace to get through all that inventory? And we're sitting at 5.8%, pretty much flat from September. So not going in either direction, which is very positive. We're kind of sitting in a balance on the cusp of a buyer's market, because a buyer's market is considered from 6 months of inventory and above. 6 months of inventory and above is considered a buyer's market. If we hang in that number for a while, it starts to put downward pressure on prices. 4 months and below, and you're considered a seller's market, where there's just not enough inventory to keep up with demand. Below our months of inventory here, you can see this reflected in this is the benchmark price that we're looking at. The yellow indicates an increase over the month before. A red indicates a decrease to the month prior. So in terms of months of inventory, we're basically flat, and benchmark price, we're sitting at 1.196. It's basically flat, slightly down for the month prior, but flat. And we're up 4.4% over the year. So first of all, we had a spectacular spring. We gained back some of those gains that we lost in terms of perceived equity in the previous fall. Now we're starting to lose it again a little bit. We made some substantial gains from the beginning of the year, almost 5% on $1 million property is quite substantial, but we're giving some back little by little. And so, not surprised by that, considering where we're sitting in terms of months of inventory, kind of sitting on that cusp of a buyer's market. And perhaps that's why we're not seeing major decreases in prices at this time. If we have a large increase in inventory and sales remain kind of flat or start to decrease, then we will start to have a more significant impact on prices. Currently, it's a bit more negligible from the overall perspective. Of course, we need to dig down into each market segment, because I can tell you that East Van condos operate a lot different than, say, your West Side detached market. So again, if you want to talk about that, please reach out to me. Let's take a look at what things cost from the entire Metro Vancouver landscape. Detached homes sales, again, basically flat month over month. Your benchmark price is sitting at just over $2 million. So you're up 5.8% year over year, and you're just down 0.1% month over month. So again, we're just flat. Attached condo sales, they were up month over month. And this should say year over year, pardon me. Attached homes were up year over year. So excuse that. 11, almost 12%. Can you believe it? Last year, townhomes, this is again, if you think back to the fall of 2022, interest rates were continuously on the increase. It was not looking good. And so this is really great in terms of, obviously, the affordable product has increased sales year over year. Your benchmark price is sitting at 1.1%. Year over year, you're up 6%, and you're virtually flat month over month. Attached condos, sales were up again 5.3% year over year. So there's increased activity from last fall. and you're sitting at 770 as your benchmark price. Your price is up 6.4% year over year and flat month over month. So you're not really giving or losing in any direction, but there's always some light at the end of the tunnel. So hang tight for more. So taking a look at months of inventory for detached homes, surprisingly, they're sitting in that 7.8 months of inventory. So almost 8 months of inventory, which would put them in a buyer's market. And our sales to listings ratio kind of confirms the same, just on the cusp from a balance to a buyer's market. And what do you know, the prices have pretty much been staying about flat in that detached segment. Now, as we get into the higher price homes, less and less people are relying on mortgage financing because they have a lot of equity. So those homes haven't been as impacted by the mortgage rates as opposed to, homes closer to around that $2 million range. However, what I would consider more of like an entry level, livable, nice home, maybe on the east side, are still, hanging in there. Some of the older product, not as shiny and new and move-in ready, starts to lose a little bit of that value there. Attached townhomes, look at that, 4 months of inventory. That is right on the cusp of a seller's market going into a buyer's market. Remember, 4 months and below seller's market. Sales to listings ratio is 25%. 22 and above is considered a seller's market. So those are still technically pretty hot product. We're seeing prices flat, but we're still in a supportive environment in terms of where that product trades. Attached condos are sitting at about 4.5 months of inventory, so just slipping over into a buyer's market. And sure enough, the sales to listings a bit more granular. You're sitting at 22%, so just on the cusp of sellers into buyer's market. The pricing makes sense. We've only given away a little bit in terms of values over this year, but you're up year over year. And who would have thought at the beginning of this year, when we still had what we thought was our last rate increase in January, that we would have had such a comeback in the spring in terms of support for prices. Our key market drivers, consumer confidence is definitely decreasing. The good news is there's bad news. There's been more job losses, inflation is slowing, and a couple other drivers are interest rates. Now, we had 2 holds, October and September, and December 6th is the next rate announcement. However, the bond market has eased off, and because it went crazy in October, and it's decreased a little bit. So we're actually starting to see a little bit of a decrease on the fixed interest rates out there. And inventory, again, increasing, but still at historic lows. So here you can see post-pandemic employment, Canada versus BC, starting to trickle off a little bit in BC. The unemployment rate overall for all of Canada and BC, again, BC being the yellow line, for all of Canada, which is what the Bank of Canada looks like, is creeping up. So it's positive news that people are losing their jobs, so to speak, with respect to increasing the interest rates, and BC is hanging out, but kind of on that trend. And it's predicted that we're actually going to be in a technical recession with the way that the economy was between August and September. They're predicting that we're probably going to have 0 to negative growth. And if we see that, then we're going to have enough quarters of no growth or negative growth to be in a technical recession. So isn't that interesting? The recession that the government's looking for has probably arrived. Waiting for those numbers, but it sure feels like it on the street. Mortgage rates, what's happened since 2020 and where they shot up to, absolutely incredible. Here you can see the bond yield over 4%. Now this is a little bit just slightly old. However, here's your bond yield now, 3.8%. You can see October 2023 we're over almost 4.4%, and we're down to 3.8 or 3.9 for the bond yield there. So therefore, once the big banks are seeing interest rates hang out in this level, the bond rate impacts your fixed term mortgages. They actually start passing on that savings on to the end consumer. And we are starting to see that. So let's just see what happens here. If the bond market starts to think there really is a greater recession coming, then you might start to see the fixed rate interest rates decrease more meaningfully. But at this point, these days, every little bit counts. Even if it's only 10 basis points, it makes a difference. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. I love to help all of you. Please send your questions along, and I hope you found this valuable. Remember, we've had massive changes to zoning. There's been new Airbnb rules. There's the underutilized housing tax. Please check out the other videos to get the details. And of course, please send along any questions or feedback that you may have. And with that, make it a great day, and I look forward to connecting with you soon.